Well, 2014 was a very good year for us. By any measure, production, EBITDA, revenue, profit and balance sheet strength was a very good result. We produced about 1.4, 1.5 million barrels of oil, and we generated revenue of about $140 million. These were about 185% up on the previous year. Of that revenue, about 75 million was net cash flow to us, and we finished the year with about $99 million in cash on the balance sheet. So it was a very good year for us. The main drivers of growth in this previous year were that we had a full year of production from our China fields. These came on stream in the first half of calendar 2013, and we had a full year's production. The field produced better than we'd planned, and this was the main driver. Secondly, with the drill bit, we had a very successful outcome at our Tinggu-1 exploration well in Papua New Guinea, and that's added significantly to our reserves book. A key achievement for us this year was the sale of a 40% interest in our PNG asset position. We have a large position in that country, and it was important for us to get a quality partner to help us develop those reserves. We've done that in attracting Osaka Gas to join us. They're a first-class company, and they have a strong interest in the LNG business. So they'll be a very good partner for us in PNG. We've realised about $200 million in the sale, $200 million US dollars. The first payment of that, with adjustments, was about $78 million, and we received that in June 2014. That money will be the basis for our investment in the Stanley Field development in PNG. That really covers our entire investment in the development. The second milestone payment is one of about $130 million, and that will be made after we've made our financial investment decision on developing the gas. And again, that $130 million milestone payment has been sized to form the core of the financing for our investment in that development. This financial year, we're expecting an increase of about 30% in production and revenues. We're expecting revenue to be around about $170 million US dollars, and earnings before interest, tax and depreciation to be about $120 million. This production growth will primarily come from an increase in production in Maari, where we have been carrying out field rehabilitation work this year, and it will also be underwritten by continuing strong production from China. Well, our operational priorities this year are well defined. In China, we have an additional field that we are currently carrying out a feasibility study on. It's called the 12-8 East field, and we will hope to finish the development plan for that field this year. In New Zealand, as I said earlier, we will have completed our growth projects program, and that will be a strong contributor to production. In New Guinea, which is really our most active area, we've got 2 or 3 priorities. The first being to move Stanley Field closer to production. Development on that field is underway and is scheduled for first production in 2016. Secondly, we're moving the Elevala Ketu and Tinggu fields in Block 21 towards production with a award of a production development licence, petroleum development licence, and then sometime in 2015 a final investment decision. And finally in PNG, we are very much focused on how we're going to commercialise our gas resources. So we'll be doing a lot of work in that area. I think the thing that has to be said about Horizon Oil is we've got a large base of reserves and resources that have been independently certified. We would anticipate that these reserves and resources are capable of generating about $5 billion worth of revenue. So that's where our focus is. Our focus is getting these fields into production. Occasionally we do see other opportunities. One of them in the recent past was to merge with Rock Oil to give us a very strong Asian presence. And we don't rule out doing something like that in the future. But our primary focus is going to be on developing the very significant reserves base that we've already identified.